If you've ever thought about investing but felt intimidated by all the charts, jargon, and billion-dollar headlines, you're not alone. The stock market can seem like an exclusive club for wealthy Wall Street insiders, but the truth is that anyone, even someone with just $100, can begin building wealth through smart long-term investing. With today's technology, financial literacy resources, and commission-free platforms, there's never been a better time to start, no matter how small your initial amount is. Starting with $100 might not make you a millionaire overnight, but what it can do is teach you the fundamentals, create habits, and open a door that leads to financial freedom. Today we will talk about stock market basics, how to start investing with $100. So before we start, make sure to hit the like button and subscribe to my channel. What is the stock market and how does it work? At its core, the stock market is a platform where investors buy and sell shares, also called stocks, of publicly traded companies. When you purchase a stock, you're essentially buying a small piece of ownership in that company. If the company performs well, its value, and the value of your shares, generally goes up. If it performs poorly, your investment may lose value. The two major U.S. stock exchanges are the New York Stock Exchange, NYSE, and the NASDAQ, but there are many markets globally. Stock prices fluctuate daily due to a combination of factors: earnings reports, economic indicators, company news, investor sentiment, and more. It may seem chaotic, but over long periods, the market has historically grown. The average annual return of the S&P 500, an index of 500 top U.S. companies, has been around 8 to 10% over the past several decades, which is significantly more than most savings accounts or CDs. Why $100 is enough to get started? A common misconception is that you need thousands of dollars to invest. That used to be true when brokers charged high fees and fractional shares weren't available. But thanks to modern investing platforms like Robinhood, Fidelity, Sophie, Webull, and M1 Finance, you can now buy fractional shares, meaning you don't have to buy an entire share of a stock. For example, if Amazon stock costs $3,000 per share, you can still invest just $10 or $20 into it and own a portion of a share. This innovation has opened the door for everyday people to invest with very little money. With just $100, you can diversify into multiple companies or even buy into index funds or ETFs, exchange-traded funds, that spread your money across dozens or hundreds of stocks. It's not about the dollar amount. It's about developing the habit of investing early and consistently. Choosing the right platform or app. The first step to investing your $100 is choosing a brokerage platform or app. For beginners, it's best to use commission-free platforms that are user-friendly and allow fractional share investing. Robinhood is popular for its easy interface and no minimum balance, though it lacks more advanced features. Fidelity and Charles Schwab are trusted legacy institutions that also offer fractional investing and educational tools. M1 Finance is great if you want to automate your investments with custom PIs, portfolios, while Sophie Invest includes free access to financial advisors. Whichever platform you choose, make sure it's SIPC insured, which protects your investments up to $500,000 in case the broker fails. Setting up an account usually involves verifying your identity, linking a bank account, and funding it, often in just a few minutes. Understanding risk and time horizon. One of the most important concepts to grasp before investing is risk tolerance. All investments come with risk. There's always the possibility that your money could decrease in value. However, the key is to match your investments to your goals and time horizon. If you're investing with a long-term goal in mind, say 10 years or more, you can afford to ride out short-term market volatility. Historically, the market always rebounds after downturns. But if you're hoping to use that money in a year, putting it in stocks might not be wise. The longer you leave your money invested, the more chance it has to grow thanks to compound interest. And the earlier you start, even with just $100, the more time your money has to compound and multiply. So always think long-term and never invest money you might need in the short term. What should you invest in? Stocks, ETFs, or index funds? With your $100, you have three main beginner-friendly options: individual stocks, ETFs, and index funds. Individual stocks are shares in one specific company, like Apple, Tesla, or Microsoft. While they can yield high returns, they're riskier, since they rely on the performance of just one company. ETFs, exchange-traded funds, on the other hand, are baskets of stocks bundled together and traded like a single stock. For example, the SPY ETF tracks the S&P 500 and gives you exposure to 500 companies at once. This lowers your risk through diversification. Index funds are similar to ETFs, but are often held through retirement accounts like IRAs or 401(k)s. A good beginner strategy is the core and satellite approach. Invest most of your money in the core, into index funds or ETFs, and, if you want, use a small portion, satellite, for individual stocks. This balances stability with the opportunity for growth. Dollar cost averaging and why it works. One powerful strategy for new investors is dollar cost averaging, DCA. Instead of trying to time the market, which is nearly impossible even for professionals, DCA means you invest the same amount of money regularly, like $10 or $25 per week, regardless of what the market is doing. Over time, this strategy smooths out the impact of market fluctuations. When prices are high, your money buys fewer shares. When prices are low, it buys more. This automatic emotion-free approach helps you avoid panic buying or selling. Many platforms let you set up recurring investments, so your $100 could become the start of a monthly contribution habit. This is how wealth is built, not by guessing the next big stock, but by staying consistent and disciplined. Avoiding common mistakes. New investors often fall into a few traps. One of the biggest is chasing hot tips or trending stocks based on social media hype. While it's tempting to jump into the latest meme stock or crypto trend, investing based on emotion usually leads to losses. Another mistake is panic selling during a market dip. Remember, losses only become real when you sell. The market moves in cycles, and downturns are normal. Don't let short-term volatility scare you out of a long-term plan. Finally, don't put all your money into one stock. Diversification is crucial, even with just $100. Spread it across a few companies, or, better yet, into ETFs. And always do your own research, DIY. Understand what you're investing in before you buy. From $100 to $10,000, the long game. It may not feel like a big deal to invest $100, but it's the habit that matters. If you continue adding just $100 per month and earn an average 8% return annually, you'll have over $18,000 in 10 years. If you raise that to $200/month, you could see nearly $37,000. Now imagine starting in your early 20s, staying consistent, and increasing your contributions over time. This is how millionaires are made. It all starts with one small step. As your income grows, you can increase your investments, diversify into other assets like real estate or REITs, and eventually build a portfolio that gives you financial independence. The secret: start early, stay invested, and let compound growth do its magic. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.